Hello, everyone. I'm your host, Cam Webster, and welcome to The Art of Boring, the podcast where we dive deeper into Mawer's investment philosophy and thinking in order to help you, our listeners, become more informed investors. Ultimately, we hope to connect you with the people at Mawer who find excitement in delivering on Be Boring, Make Money. On this episode, we speak with David Ragan, portfolio manager of Mawer's international equity strategy, on investing in Japan. There are a few quirks about Japan that have led Dave to hold certain opinions about corporate structure, cultural nuances, and management quality that may surprise listeners. While you may think Dave is such a drag when it comes to Japan, rest assured there are some positives. And he leaves us with one more thought, connecting rock climbing to investing. Thanks for listening.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
With us today is David Ragan. He's the lead portfolio manager of international equity, and we're here today to talk about Japan. So the current weighting in your fund, Dave, is about 8%. It's about halfway to the benchmark. So we want to get into a discussion of that. But before we do that, what we'd like you to do is just give us a little introduction of who you are, why you're an investor at Mawer, and your history at the firm.
Sure. Well, I joined Mawer back in 2004. And actually from day one, I was working on the international strategy with Gerald Cooperkey at the time. Then in 2007, I was made co-manager with him. In 2010, he retired in March, and I took over as lead manager, and that's where I've been ever since. It's been a pretty boring trajectory. I'm now where I have been for the last 10 years and probably will be for the next 10 years. The reason I'm at Mawer is I got lucky. It's a fantastic firm. I really didn't appreciate how special it was. And this is coming from someone this was my first job out of university, and it's not expected to come into a job thinking that I'm going to retire here at some point within about 6 months of joining. So that's why I say I'm lucky. The whole interview process, maybe one thing that set me apart was I had just gotten back from my last semester. It was an exchange to the Viennese University of Business. So it was a little bit different. I think did help set me apart and made the individuals that hired me, which was most of the research department at the time when everybody gets interviewed by everybody still. Probably one thing that set me apart from all the other individuals was that international experience. And, well, international is in the name of the strategy, so let's put them there.
You mentioned Gerald Cooperkey, and we're talking about Japan. So my immediate question is, what was Gerald's view of Japan, and is it similar to yours?
Yeah, well, I mean, Japan is a market just like any other. That's fundamentally what we believe. There's a lot of different companies in there, and there's a lot of differences between those companies. But within Japan in general, you do have, more commonly do you find companies that don't meet our investment philosophy. Gerald started this fund back in the 80s, and I mean, back then, it's, at least with hindsight, it seems pretty black and white why he was massively underweight this market that was trading at 64 times earnings. People thought it was going to take over the world, and it's pretty unlikely that that's the case. And these companies, some of them were good, some of them were not so good. The valuation was probably the main reason why you wouldn't invest there at the time. And then they underperformed for 3 going on almost 4 decades. Over this whole period, it's underperformed, and valuations have gotten a lot more reasonable, where the PE is much more in line with other international markets. So now it's coming down to other reasons that we turn down a lot more companies in Japan than elsewhere. And Japan's not alone in the problems with governance or with management teams. There's definitely other areas of the world or other countries of the world where just the mentality of the managers isn't what we look for. So and this has been in a podcast previously, where we're looking for wealth creating companies, smart ethical management teams, and stocks trading at a reasonable price. And that management team comments is tied in with the wealth creating part, where you have to be looking for management teams that are investing in wealth creating projects that they have a high return on capital potential, projects where they have a competitive advantage. And you don't get that as much as elsewhere in Japan. You get managers that are more focused on building a big business because it would be very prestigious. You get more situations where they don't really care if they have competitive advantages or not necessarily. They're looking to maintain the business that they've had and to keep growing. Again, going back to that big business idea. The other aspect is more just the not making waves, the society concept within Japan. It's very important to be a good citizen, and that's a corporate citizen as well. You don't see layoffs as much in Japan as you do elsewhere. People tend to have a job for life, which if you're in a dying industry, really that industry should die. It shouldn't be artificially kept alive by competitors or by banks.
So does the culture lead to maybe less margin expansion over time, or does that flow through the financials?
Yeah, companies can be reinvesting in a business line, putting new capital into something that's not even making a profit or barely breaking even. It can also be they'll sacrifice margins or revenue because they know their customers can't afford it. It's a weaker customer. They should be going out of business. There should be some other company, maybe in Japan, maybe or somewhere else in the world, taking their place, the whole creative destruction idea. But it's not, because it's being artificially kept alive by their suppliers.
Do you have a specific company example?
We were in an interview years ago, and I can't remember the company, but we just couldn't understand why this company's margins weren't suffering. There was all indications that input costs should be going up, their prices should be going up, and they should be having some more problems. But they eventually got exasperated with us when we kept asking the same question in different ways 2 or 3 times, that they just said, you don't understand how business is done in Japan. Our suppliers know that we can't afford higher prices, so they don't pass them on to us. And I mean, this isn't something you'd expect to hear from anywhere else, where there's charity going on between businesses. And that's something you do see on occasion in Japan.
That's a good introduction to some of the differences. What I'm curious about, is there a bias in your thinking? Because Gerald kind of looked at Japan and went, well, yeah, there's not a lot of wealth creation going on there. And then...
Yeah, I mean, the internal bias is not exactly something that I could see clearly if I had one. But that is part of the job, to always hold up everything with curiosity. And that includes all these companies around the world where, a Japanese company, I'm actually talking to one tonight. It's got a good return on capital. It's improving. So, I mean, I just screen the world sometimes, and I come across a new Japanese company that has a typically good business model, and the numbers kind of match this, then I'm going to talk to them. Aside from arranging times and translators, you don't treat it like any other company. You ask the same questions. You're trying to fundamentally get down to, how do you make decisions as a management team? Why did you make that decision? And you're asking about why they made past decisions, where they don't just get to talk hypothetically and potentially give you scripted answers, or even some will outright lie to you about how they make acquisitions. And some companies, not just Japanese companies. So you want to follow it up with actual examples. Well, how much did you pay for that acquisition? Why did you pay that much? Why does it meet your stated return on capital hurdle? So I absolutely might have a bias. And in fact, I'm more worried today about my bias of getting too excited for a mediocre Japanese company just because it looks okay.
Right.
And just because the hurdle has been so low in so many cases where you do talk to a company and it's just brutal how they allocate capital. I mean, today's example, I'm talking to a company that has a 10% cash hoard. So they have no debt on the balance sheet, but they have 10% of the market cap in cash, which my first comment was, that's pretty good. It's not 30%. Where we don't actually want companies to have a bunch of debt, but sitting on so much cash is just a drag on the balance sheet and drag on return on capital. So, I mean, they could definitely cut that down and make it more reasonable. But to the question on the bias is, I might actually be overcompensating.
Right. You feel you need Japan in the portfolio, or?
No. I mean, the beauty of our philosophy is that we don't have to be anywhere. Our clients are looking for international exposure with following our philosophy, wealth creating companies, great management teams, reasonable price. They don't specifically want us to be like the index, and that's very clear to them when we're hired, is we're not going to be like the index. So we don't have to be in Japan, but it is a diversification benefit for the portfolio. So we're happy to find a good Japanese company and add that, because I mean, not only does Japan move a little bit on its own cycle, but the Japanese yen is supposedly, in theory, still a reserve currency. And back in 2008, 2009, we saw that, where it went up materially. So in the event of a crisis, this does actually help us. So we don't have to be in Japan. There's some benefits but we're definitely not trying to bring our weight up to the index weight.
I'm curious more about the structure of the Japanese economy. Like, is it, given the process and the fact we're looking for good business models, is Japan inherently lacking of good business models, or where in those steps in our process does Japan tend to get eliminated?
Well, I mean, the business models in Japan are probably not that much different than the rest of the world. They have drugstores just like we do. They have internet companies just like we do. So that's not really the problem. I mean, some of the structural problems with the businesses is more historic, where Japan was a more isolated island. Once you maxed out the demand for a widget, you went on to the next business because you wanted to keep growing, and you'd make something that may or may not have anything else to do with the original widget. And I mean, one example that I still remember reading at the Bloomberg terminal in the business description is, which is it's our first step when we're screening this. Okay, what does this company do? And it was a company that had, I believe they made fishing nets. That was one of their products. They also made bread.
Well, yeah, you need bread to go with the fish sandwich, I guess. I don't know.
Yeah, and I guess another extension from the fish net was fishnet stockings, because they also made stockings. Yeah, it was rather surprising. I didn't ever talk to them, so I can't confirm or deny that there's competitive advantages that translate between these businesses. I hold that lightly, but it seemed unlikely. You're
saying valuations have come in over decades, more comparable to other international markets. Is there anything about Japan that gets you excited? What are some of the signs maybe or are there any signs that things are changing?
Maybe. A few years ago, Abenomics was a term that really got popular, and in the January period, Abe was reelected again as prime minister, and he launched this plan to launch 3 arrows: get inflation going, you're no longer stuck in this deflationary spiral, which it has been for a long time. So get actual economic growth, get people investing, get wages going up. The final arrow was actually a cultural change, where a culture of openness to change, a culture that allows better governance and less corruption in various businesses. And that was the one that I think, if that arrow we saw evidence that it really hit or was really happening, would have been very exciting. And just like anything, when you're looking for evidence that it happened or is happening, you're going to find it. Because like I said, there's some good companies in Japan. And then there's some companies that made some changes there. And I can't really say that it seems like it's actually been a wholesale change, but there's been obvious examples. And these stocks that announce increasing their payout ratios, so they'll pay down some of this cash hoard, they would go up 20-30% overnight. And the whole market just started to go up very rapidly that year, thanks to Abenomics. And our response in that period was we sent over a researcher, and he did the screen of all of the Japanese companies. We had 3 or 4 people do that. And he spent a couple of weeks talking to all these companies to get an idea of, all right, is there any companies there that match our philosophy? And he actually came back, we have the right companies. Our existing holdings are the best ideas that we found. So we were happy to, stay materially underweight, even though actually we're pretty confident that the market was going to be on a tear, because the central bank was going to flood the market with money, going to buy all the equities. And that's usually very buoyant for prices. But fundamentally, there was no real change. And that's probably where we still stand today. I actually talked to other entities and a Japanese newspaper. They were asking very probably optimistically, it's like, have you seen the changes in Japan? Is it a lot better? And I mean, my response was, I think it might be a little bit better, but the hurdle, the bar you're measured to has been so low and still is so low that it's not getting you anywhere near the best countries in the world for governance, for example, where you're lucky to have maybe half of the board members on a board to be independent. Usually they're executives or associates of the executives or customers, suppliers. That's not the best way to make decisions. But even ISS, a proxy voting system or company, says that, as long as, I think it's a third or maybe a half, it's probably a third of the individuals are independent, will say support the board. But in any other geography, that would be a no. That's not unacceptable. But it's in the context of the land that's okay, I guess.
So what would the UK look like from an independent board composition?
Yeah, most of the time, it's majority would be a minimum, but it would be much more than that usually for the board to be independent. yeah, you typically have an independent chairman, which helps there. It's really expected that compensation committees don't have executives on there, and it's more independence. So a lot higher expectations around the world outside of Japan.
So if you had a magic investor-friendly wand in Japan, what kind of spell would you cast? Would it address corporate governance? Would it address 30% cash? What would you wave it at?
The mentality of capital allocation would be the change. If you have the right management team in place, in theory, you don't even need a board. In reality, it's very helpful to have a good board that is a second, hopefully independent mindset, thinking about the decisions. But yeah, a management team that's thinking about allocating capital at high rates, that is open to shutting down divisions, that's open to offshoring if labor prices are getting too high, which they are, causing problems in Japan. Just again, coming back to that, how can I increase the return on capital of this business over the long term? And this isn't a short-term mindset that we want. We want them thinking 5, 10, 20 years down the road. That would be amazing. And that would, I think, create a lot of value. Even just releasing all those either cash reserves or their share. It's very common to hold shares in your related companies and the suppliers, customers. It's part of building a relationship. Even in the bank, or the bank holds shares in you. Getting rid of all of that is just capital sitting there in the system, and actually gives that weight that the index has an artificially high number as well.
Given all that description, there are 2 Japanese companies in the top 10 holdings in international equity. So Tsuruha and Seven & i. What about those 2 companies address some of the concerns you've just given us?
Like I said, they're not all bad management teams. Tsuruha is a drugstore, a surprisingly fragmented industry in Japan. They're able to grow for a long time. And in a country where the discount rate is so low and growth is so low, any sort of growth is actually quite valuable. So, we've seen their track record of being able to roll up the industry, replace mom and pop shops with, something like a Shoppers Drug Mart, a smaller version, but where you have people in the store getting prescriptions filled primarily for the purpose to sell them everything else around that. Cosmetics are very high margin, all these impulse items. That's where money's made, and ideally you keep them in there as long as possible. We actually got the idea for Tsuruha and another drugstore that we have from the Canadian equity team and the Shoppers Drug Mart example. So yeah, you have a smart management team. That's their business. They're growing it. That's why it's there. It's not a Japanese company that we had to have. It's a good company that stands on its own merits. The other company is a bit more interesting, even on the management side, because Seven & i. Initially, when we actually did a research focus on convenience stores around the world and then eventually Japan, we came across Seven & i and its competitor Lawson, 2 of the 3 major companies. And we turned down Seven & i because the CEO at the time was reinvesting capital in the business into department stores and money-losing enterprises. As I highlighted before, this is the norm. And much to our absolute surprise, one day a press release came out saying that CEO had been fired by the board and he's been replaced by the head of the convenience store divisions. And we found out the story was basically that there was a power struggle internally. The convenience store head was pushing for, and there was actually an outside shareholder pushing for this as well, just invest more in convenience stores where we're making money and we have a good competitive position, and invest less in all these other units. And this was sacrilegious to be stood up to by a subordinate. So the CEO supposedly wanted to fire the other head, but then the board actually took the now CEO, the head of the convenience store division, took his side and put him in charge, fired the old CEO that was making those bad capital allocation decisions. We got this press release early in the morning, Calgary time. We had the full day to review our previous work, which we had talked to management. We had done the model, we'd done everything. And we actually initiated a position that night because we saw this fundamental change in management, how they make decisions, what their targets are. And that's where we think there's a lot of opportunity, where, this company can still grow, still build the business internationally, and they're not going to waste the capital as the previous management team did. And
curiously, they probably sell bread and nylon stockings.
Well, in Japan, 7 & i is actually a lot more, 7-Elevens are a lot more food. So they probably sell bread and a bunch of other awesome little snacks. I wish we had them here. They're fantastic. But it's less the other household goods. things like that. Less the convenience stores we know, more quick service food.
Dave, thanks for that big overview of Japan. I think we get a good sense of what drives your decision making, and more as a firm and as an investment company, we're not ignoring Japan. It's just we're looking for these signals, and you've given us a couple of good examples from the portfolio that sometimes things come along. There's maybe a change in CEO, which is counterculture, and that's a big signal. So thanks for sharing that. What I want to kind of wrap things up on is one more thought. And this is where we try and get you to relate something that you do personally. So I know you're an ice climber, you're a rock climber. What within rock climbing or ice climbing do you relate to investing, and maybe vice versa?
Sure. I do a lot more rock climbing than ice climbing because, in all honesty, ice climbing is a little bit past my danger threshold. In rock climbing, the core is you never have to hurry to make a decision. And very much the same for us, where if you're trying to rush anything, if you're not double, triple checking things, it can be a big mistake in either part of my life. So I really appreciate the focus that rock climbing requires and just the slow, methodical, step-by-step caution.
Great. Well, thanks for joining us on the podcast. We'll have you on again soon, I'm sure.
Thank you very much. Appreciate it.
Hey everyone, Cam here again. To subscribe to the Art of Boring podcast, go to Mawer, that's mawer.com/podcast. If you enjoyed this episode, leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Again, thanks for listening.